My brother Jamie is in printing. He knows more about putting ink on paper or ink on anything than pretty much anybody else I've ever met. He is extremely knowledgeable. Companies will hire him to ask all sorts of crazy questions, and he loves to talk about it. So we get together at a family dinner, and Jamie will bring up some really crazy printing term that he thinks we all understand. And we have no idea what the heck he's talking about. I can't even think of one of those terms right now. But you can see the passion in his face when he does that. Right now, I want to talk about one of those completely strange topics when it comes towards taxes and retirement planning. And that topic is specifically capital gains. It's a lot of fun, right? Capital gains taxes. First off, let's understand what capital gains taxes are. Capital gains taxes are not inside of your IRA. They're not inside of your 401k. They're not inside your Roth. Capital gains are things inside of what we call non-qualified accounts. Non-qualified just means it's not an IRA, it's not a 401k, it's non-qualified. Now, what happens is if you buy an asset, and this is true for individuals, this is true for corporations, you're going to buy it for a certain dollar amount. And let's say you bought something for $100 and you hold on to it for a period of time and you go to sell it. And when you sell it, if you sell it for more than you bought it for, guess what? That's considered a capital gain. So if you bought that asset for 100 and you sold it for 150, you have a $50 capital gain. And that capital gain is taxable to you on your tax return. Not the full 150, but just that $50 gain. Now, where does this come into play? Well, this comes into play in regards to real estate. Yes, it happens to your primary residence. People buy real estate and they sell it a few years later, and hopefully it's gone up in value. But it also applies to rentals. If you have lots of rentals, capital gains will apply in a lot of those situations. It applies to stocks. Can you imagine people that have bought Apple or Amazon or any of those crazy high-performing stocks about 5-6 years ago? We could have a ton of capital gains that we have to worry about. Now, under current tax law, capital gains have a very special tax treatment. They have their own tax rates. Those are taxed at either 0, and if your income is in the lowest of the two brackets, you pay a 0% tax on that. It could be taxed at 15%, or it could be taxed at 20%. Now, why is that good? What does that do? Well, that encourages investments. That encourages people to go out and buy stuff and create stuff, and it encourages investments. Now, one of the ways that President Biden is trying to raise tax revenue is through a change in the capital gains tax structure. What does that mean? He wants to change some of those rates, and he wants to change how those assets are taxed. So what does that mean? Well, it means for the highest income earners, that capital gains rate change is going to go from 20% up to the maximum of almost 40%. What does that mean? Well, that means to a lot of people that they're going to inherit less money. That means they're going to have less money for them to use moving forward. One of the key tips and tricks that people used to use all the time is if you had a highly appreciated asset. Highly appreciated is a technical term for you've got an asset with lots of capital gains built into it. One of the tax treatments we used to say is die with it. If you died with it, what happened is whoever you left it to received something called a step up in basis. So that means that when they inherited that money, let's say you bought Apple for $10, it's now worth $500. When someone inherits it, their new purchase price, quote unquote, is now that $500. So they could sell it immediately and recognize no capital gain, or they could sell it in the future and they're only going to pay the capital gain based on that $500 limit. Now, when you're talking about $500, it's really no big deal. But if you start talking about $50,000, $500,000, $1 million, now we have a really big deal if those capital gains tax rates change. And the other thing is, if they eliminate that step up in basis, they're talking about making death what they call a recognizable event. Tax classes in college used to always talk about what is recognition, when does recognition happen? But recognition is when you actually have to claim that income. Right now at death, you don't have to claim that. That's not income. Whoever you're passing that money on doesn't go on to that heir. When this becomes a recognizable event, that death becomes a sale. And what that sale means is those people are going to have to pay taxes. Now, again, a lot of people don't care if quote unquote wealthy people inherit less money. But you know what? if you are one of those quote-unquote wealthy people, you probably care that your children, your loved ones, the charities inherit more money than Uncle Sam does. And this is going to be one of those major tax planning topics that we're going to have to address immediately. And how you handle capital gains, what this means is death is no longer an option. You really have to understand what the purpose of this money is. And if you're going to do something about it, timing may be of the essence before there's some sort of major capital gains tax law change. I hope you got some value out of the video you just watched. And if you know somebody else that might benefit from seeing this, please share it with them. And to see future videos that we produce and put out, please subscribe to our channel.